Hello and welcome to eOptions webinar, and we're excited to have you here and thank you for taking the time out of your day to join us. We're happy again to partner with Teddy Keckstadt, a professional trader with over 30 years of experience, to bring you this webinar today on year-end holiday option strategies to help keep the Grinch away. My name is Gina Bocayas, and I'm with Regal Securities, the parent company of eOption and InvestTrade. And to provide some basic logistical information, the session today will last approximately 1 hour, and every attendee who's participating is muted. If you have any questions during the webinar presentation, please feel free to type them into the question box, and our speaker will answer those at the end of his presentation. We ask that you use the Q&A box and not the chat box, as our speaker may not see your questions. You can also reach out to our trade desk at any time if you have additional questions after the webinar, and they're happy to answer any questions you have on placing trades, placing option trades or spreads, or any questions you have about strategies. You can also access the recording of the webinar in the next week on our website at eoption.com, and we will also be emailing you a copy of the recording in the next week. And for those of you just joining, we'd like to welcome you to our webinar on year-end holiday option strategies to help keep the Grinch away. And as eOptions' name implies, we are a firm that specializes in option and stock trading. We charge some of the lowest option rates in the country. Our option rates are just 10 cents per contract plus $1.99 per trade, and all of our stock and ETF trades are commission free. We can also offer you a powerful trading platform, a mobile app, free trading tools such as Options Play that demystifies options trading, as well as live expert support when you need it. We encourage you to go to eoption.com so you can learn more about us as well as see all of the resources that we can offer you. We also support option education, and we're glad you can join our webinar today to learn more about using options to trade in this volatile environment and how to secure your gains in 2020. And again, I encourage you to go to eoption.com. You'll find more educational videos, past webinars, as well as option education resources there. And without further ado, I'd like to turn it over to our speaker now, Teddy Keckstadt. Teddy has over 30 years of experience in the financial industry and trading. Some of you may recognize his name from past webinars he's done for eOption this year, and we're excited to welcome him back today. And to tell you a little bit about him, Teddy has over 30 years of trading and industry experience. He traded on the Chicago Board of Options Exchange, Chicago Mercantile Exchange, and Chicago Board of Trade for 21 years. And he's been an institutional market analyst for over 25 years. He currently serves as president of Forex Trading Unlocked, and he's also written a book called High Probable Japanese Candlestick Patterns. He has a degree in finance from DePaul University in Chicago. And without further ado, I'll turn it over to Teddy Keckstadt. Thank you.
Thank you, Gina, for that introduction, and thank you for everyone that's attending today. Real quickly, we just want to put up the eOption disclaimer to remind you that this webinar is for illustrative and educational purposes only. For more information, you can also go to the eoption.com website and check out the disclaimer page there as well. We can skip past my disclaimer. So what are we going to do today? We're going to maximize your option trading potential. That's our goal, is to teach you some strategies that'll help you to deal with not just these holiday markets, but other future markets to come. So use eOption for your stock, ETF, and options trading. Also make sure you take advantage of that option strategy tool book that's on the options for Options Play, as well as also the option strategy guidebook at eOption. So, and we're going to go through some of these different trading scenarios, and then you can try them out also on those through those tools also. So what are you going to learn today? Well, you're going to learn how to trade stock and other market movements without large capital allocations, for one. You're going to expand portfolio diversification. You're going to learn how to maximize your potential returns with options, bear and bull directional strategies, and also how eOption can help improve your bottom line through these strategies. So why stock option strategies? First and foremost, to lower your cost basis. At eOption, it's only 10 cents per contract, much lower than other firms. So one off, just using these strategies alone and also using them at eOption will help you with any of your systems that you already have going or that you are thinking about implementing in the future. So trading in these products is very similar to trading in normal equities, but with a higher potential ROI and controlled risk. So by doing these strategies that we're going to talk about today, you're going to find out how you can not just be involved in the equities market, but be involved in a way that gives you much more control of the opportunities that are at hand, as well as control over your risk. And that's one of the biggest things that you want to be controlling. So option strategies to keep the Grinch away. Let's get started. All right, today's focus, end of the year option strategies, bullish and bearish strategies. We're going to define the risk through each of these 4 strategies that we go through. The execution for these strategies is very simple. So whether you're a beginner or an experienced options trader, no matter what your level, you'll be able to execute these very easily. Volatility, direction, and cost, meaning the commission and the spread, are all the key variables. Now, the nice thing about this is that, especially for the options parts, the cost is very minimal. All the markets we're looking at are very liquidable, meaning heavily traded. They have a lot of volume on any given day, even on slow days. That's good. The more volume you have, the tighter the bid and ask spread is, the more easy it is to not only just get in and out of positions, but you get a better pricing model. And the volatility, well, we all know that the market currently is on its highs, and it seems like every day doesn't matter which index or what you're talking about. For the most part, the markets have been very strong going into the end of this 2020 year, which has been very volatile. And possible exercising of options. We will relieve your angst about that during this as well. So there's always a lot of people that have questions about, well, what happens? Am I going to get exercised on? So we'll cover that as we get through these individual strategies. So the first strategy that we're going to talk about today is the married put. So what is a married put? Oh, let's say a trader buys an asset like 100 shares of stock or an ETF. Now, for each of these examples, whenever we talk about an option contract, one option controls or is controlled by 100 shares of stock. An ETF would be just an individual ETF, and then there's options per ETF that you would be balancing, should that be the equity or investment that you want to use a married put strategy for. So the trader will buy a put option for each of the 100 shares of stock that they own, or for each ETF that they have. Okay, so the trader can sell the stock ETF at the strike price if the market goes lower. So what you're doing is you're putting in a synthetic floor. Okay, so this strategy sets a price floor in case of a sudden bearish break in the market. You can kind of think about it as if you've been long an investment, no matter what company it is, whether it's Tesla, Amazon, Apple, you name it, whether it's one of the high flyers or even this regular, more bargain basement stuff like Johnson & Johnson and things, and GE, no matter what the equity is, if you have been in that for a long time collecting dividends and you're positive on your position, you can definitely lock in a price floor, and that's what a married put does for you. So what it does is it locks in your gains that you've already had. You may lose a little bit if there's a market correction, but you don't lose the bulk of your gains. And that's what when we get into the example, you see what that means and what we're talking about. So a trader uses the married puts as a way to protect against a stock in a stock or ETF. You can look at it like an insurance policy. So if it hasn't made sense yet, just think about your insurance policy like you have on your car. Okay, so just like when you buy a new car, your insurance policy is never going to cover it for what you paid for it, but it's going to give you fair value. So that's kind of what you're doing with this, is you lock in a fair value floor. So even if there's a sharp sell-off in the market, like we could have another coronavirus shutdown like we have now that escalates like it did earlier in the year, causing a big sell-off in the market. If you have a married put on, you're totally taken care of. So if the stock or ETF gains in value, okay, then your gains are reduced by the premium paid for the put. So that's what you have to remember, is that you do pay for this insurance policy. But the good thing is that if the market goes up, so does the value of your equity or your ETF, meaning that you'll be seeing gains. They just won't be quite as strong as they would have had you done nothing. However, your risk exposure, if you do nothing, is unlimited, because then if the market collapses, you're stuck with a decreasing asset that has no type of chance of coming back for you as far as on an equity basis. So the trader only loses if the asset does not fall in price or move at all. So is that possible? Sure, markets can drift and go sideways for a long time, but no matter what, you will have that hedge on. So now let's take a look at our visual example so you can see what we're talking about here. So for our married put example, we're going to take a look at Coca-Cola. Everyone's familiar with Coca-Cola. Now, at the time when I started making the presentation for this webinar, the Coca-Cola stock price was trading right around just over $53. So you can see, as we have highlighted this green line here, this is your stock price. The options that we're looking at are the January 15th, 2020 expiration. Okay, so at the time when this was done at the end of November, that would have left just over a month, close to 45 days of expiration. It was right before, around Thanksgiving. Now, typically when you want to do these kinds of strategies that we're talking about, you want to use options that are 30 to 45 days out. So once again, if you look at the upper left-hand corner here, you can see January 15, 2020 expiration is the date used, and all of these will be for that date. There are different strategies where you use multiple expiration months. Those are for much more advanced options traders. We're not going to muddle through any of that today to confuse anybody. So for this one, what do we do here? So the trader buys 100 shares of Coca-Cola at $53.30. So let's say that you weren't even long this market for however long, since you were just started trading 20 years ago or 2 weeks ago. Let's say that you just today decided to get into Coca-Cola. The market's near, at that point, was definitely shaking around its highs, lower than it is now, but definitely near its highs at the time. So what would you do just to protect yourself? Well, in this kind of scenario, you know that you like the stock, right? But you're worried that there's a potential correction in the market. And then here, see what I did here? I highlighted this gap. Now, the reason I highlighted this gap was to give you a reason to have, even in a bullish scenario, an inkling that possibly you would get a correction. Okay, so we're not trying to predict the market here, but we're trying to put what would you do at this moment in time if you bought Coca-Cola and you wanted to be hedged. So you're obviously bullish to stock, you're looking forward to collect dividends, but you're worried about a potential correction. So what do? You take either the 52.50 strike or the 52 even strike price put, and you purchase one of those. So what does that mean? That means that at the 52.50 strike price, if the market starts to fall below that and the stock price goes down, that means that while you're losing money on your initial stock, the price that you purchased Coca-Cola at, or if you'd already had it, you're losing gains that you had already realized. While that's happening, your put would start to go up in value. Okay, so that gives you the right, remember, to sell that stock at that price. Okay, so that locks you in with the floor. Especially think about what happens if Coca-Cola all of a sudden drops down to $49, $40, $48. Okay, a severe $5 a slide in that market, then either whether you had the 52.50 strike price or the 52 even strike price, your stock position would be covered. So while you were at that moment realizing losses in your stock position, but still with the ability to collect a dividend, your puts would be going up in value, whichever one that you would choose to take. Now, why would you want to do this besides just using it as an insurance policy and locking in a floor? There's this gap. Now, if you just wanted to look at it as a technical trader, all gaps typically get filled. That's just a fundamental part of technical analysis, for basic technical analysis. So let's just say that no matter how much of a bull this market is, and this market has been going up, making higher move highs and higher move lows, that's indicative of a bullish trend. It doesn't mean that it wouldn't have a correction. Irony is, look at this. If we were to cover this stock price, stock trade here, when the market was trading at $53, whether you use the 52 or 52 half strike price, that comes right into this gap. It's kind of like a really nice sell area where, let's say the market comes back to here, it would find support once it fills this gap and then comes back up. So long term, your stock would be in a good place, hopefully. And if not, at least in the short run, your short-term losses would be covered by the value of the price of the put that you would have purchased, whether it was either the 52.50 or the 52 even. So once again, these two purple lines here, either one of these would be the strike price levels. Now, obviously, the closer it is to the stock price, the more expensive that option would be, because there's less room before the market before that option would kick in as far as pricing. Now, when it comes to option pricing, here's the nice thing about this trade. Volatility, if it was to go down, okay, that would be the one thing where you could see a lot of value in your option decreasing. Now, if the market doesn't go anywhere, let's say that come expiration, that the price of Coca-Cola is right around 53 or 53.50. It's above either the 52.50 or 52 even strike price. Well, at that point, your options would become next to worthless and definitely worthless upon expiration if the market goes nowhere. But you would have that insurance policy during that time. Now, the question is, what has happened since then? So real quickly, we're going to show you what had happened. So if you put the market, that trade on, the married put, this is where this black arrow was, the market actually got down to 51.05. Okay, and there's still time before expiration. So now what does that mean? That means that a couple of weeks ago, it came down in here. At that point in time, you would have been down in your stock position, but the options, either one of these, had you purchased them, their value would be higher. So at that point, you'd be able to either sell the option, okay, which would be great because if the market moves down, their volatility would be increasing. So where you would have purchased the option at one point in time at X volatility, a move like that would cause not only the price of the option to go up because of the movement of the stock, of the underlying stock, but also the fact that volatility goes up. So now time decay always works against you. That's always shrinking the price of an option. So the option you purchased, no matter what, is losing time value, no matter what. But if you have market movement and also you have the volatility, that would override the time decay, and you would have a profitable option that you could sell out of. Now, the question is, would you then put on another one? That's what you do, is when you have market movement, you have a set direction. You're not looking for a major extreme move in the market for months, because these options only expire within 30 to 45 days. So you have to have rational expectations. Now, that chart that I just pulled up, you saw that where is Coca-Cola right now? Well, it's actually trading right around where it was when this slide was made. So at this point, if you were to still have these options on, the options prices would be lesser in value, but you still would have the insurance policy going on until January 15th of 2021. So that would still leave you with another over 3 weeks yet of insurance as far as your position is held. Now, the one thing that could happen, remember, with markets on its highs, Coca-Cola actually isn't making new highs. What if Coca-Cola starts to catch up with the rest of the bull market? Well, the nice thing about a trade like this would be your stock price goes up as it starts to make new highs. The only difference in your profit versus not having done the trade would be the premium that you paid. So if you bought the 52.50 put at $1.42 or the 52 even strike price put at 64 cents, obviously these numbers are multiplied times 100, so that'd be $142 and also $6.40. So it's not like a matter of, $64. So it's a difference of either one of those trades minus your 100 shares of stock in the appreciation of the price should it make new highs. So that's the one thing that you have to think about for this trade. So now we're going to take a look at the next one. So the bull call spread. This is where a trader buys a call at a specific strike price. Okay, the trader sells a call at a higher strike price. Okay, so there's two options that are of the same expiration month. So like we're looking at all these options that we're strategies we're looking at are for the January 15th option expiration. So in this case, the trader would be buying a call at a specific strike price and then selling a call at a higher price above that strike price. Both options, once again, will have the same expiration date and underlying asset as well. The strategy reduces the net premium paid and limits upside potential at the same time. So meaning that whereas in the first example, you had bought the stock or you'd already owned the stock, and then you bought the put to lock in a floor, in this case, you don't own the stock whatsoever, or the underlying asset, but you're looking to take advantage of potential price movement. This type of strategy is called a vertical spread. Okay, so vertical spread, hence the name, it's exactly what it says. It's a vertical spread, meaning going up. So if the trader is bullish with expectations of a rally to higher prices, this is when you would put on a bull call spread. So instead of just buying Coca-Cola, like in the last one, you wouldn't buy the asset, because let's say you don't have that kind of money to buy a whole 100 shares or more to have big blocks of Coca-Cola and then hedge them with options. Well, in this case, you can take advantage of the movements in Coca-Cola, at least the bullish ones, with the bullish call spread. Okay, so less pricey than buying an outright call, but lacks the upside potential. Remember, if you were to just buy a call, that would be like being long the stock, but at that underlying strike price. And then if the market is above that strike price, that option would be of value. If the stock falls below the strike price, the call's value is negated, except for any time premium that would be involved in that option. However, in this case, if you were to buy the stock or just the one call, if the market rallies, no matter how high it goes, you have all that upside potential locked in. In this case, the market can rally to the moon. All you have is your upside potential between the two strike prices. And this will become clear once we get into the visual example. So this is less pricey than buying an outright call, but lacks the upside potential. Now, if the stock or ETF drops in value or does not move, then the trader only loses the net premium paid for the bull call spread. So the nice thing about this is your risk is totally limited to, once again, to the premium paid for this spread. Okay, now let's take a look at what is Teddy talking about here. Okay, we have the bull call spread here for the Coca-Cola chart pulled up here. We have the two strike prices highlighted here. There is the $55 call strike price and the $52.50 call strike. Now, remember, in this case, you do not own the stock, but this is a way of getting long and having a really good bang for your buck as far as your ROI potential. So the trader in this situation, at the time when Coca-Cola was trading around $53.32, you would be buying the $52.50 strike price, and that call at the time was $1.82, which would mean $182 in actual price. And then there's the $55 strike call that you would sell simultaneously to put the spread on. And that would be for 79 cents, which equates to $79. So basically, you have not quite 50% of the total pricing there. So it's around, $80 would be to put on this spread versus buying the whole 100 shares of Coca-Cola for $53 plus $100. Now, so remember, the only difference, though, here is that in this case, should Coca-Cola go even up to $150 in a couple of days, you only make the value between the $52.50 call strike price and the $55 call strike price. Okay. Now, the nice thing about it is you already take that premium, or excuse me, you already know what your risk premium is on this spread. The only thing that you can lose is that difference of is what you paid for the debit, meaning that the price of the call is more than the price of the $52.50 strike price call is more than the price of the $55 call that you sell. So, but that difference, that debit, is the only amount of money that you would lose should the price of Coca-Cola go down to, say, $25. So in this case, instead of having the stock where you would be losing equity, you know your risk is defined. Now your upside potential is also defined too, because should the stock go above $55, which is that's what you're hoping it would do for this position, you won't, if the stock goes to say 56, 57, 58, even $70, anything beyond $55, you will not realize any gain on that. So once the stock pierces the $55 line, that's when you would be exiting the bull call spread, because you've already hit your target, your expected target area, and anything beyond that, you reach a point of diminishing returns, meaning that up to expiration, you'll lose time value. Every other part of the equation will be locked in, but it won't change. So, and once again, also, you only risk the pricing of the spread. So in this case, it would be around 80 some dollars, minus the 10-cent commission, or 20 cents for the two options that you would put on. Now, once again, also, if you remember that as far as the cost basis for this, think about if you were to exercise, if you were really like Coca-Cola, if you were looking for a long-term investment, this would not be the position for you. However, for the speculator, especially since the market's on its highs right now, if you believe that the indexes are going to remain bullish, and Coca-Cola right now, which has been in a somewhat of a rally over the past month, but hasn't been keeping up with the broad market. Maybe this is getting ready to catch up. We'll see how things go. That's irrelevant as far as the longer term, but at least for our option play here, we had an expiration of January 15th. This would be a good way to try and realize some year-end gains on a rally that, let's say you're shaky, you're bullish the stock market, you're bullish Coca-Cola, but you know that it's been a big run, you're coming into fourth quarter end, year end, and what have you. So there's a potential for, there's always a potential for a sell-off, but maybe putting a stake in the stock is something you don't want to do, but you want to still participate. So bull call spread would be a very good option for you in that. And just to show you how that is panning out, we have the chart actually right now showing you where the Coca-Cola is trading. So it's trading basically right where it was when we started out with this chart here, when we made the webinar a month ago. So as far as this bull call spread, it still has potential. And as you can see, the trend line holding up the market right now over the past 2 months, it's riding right on that right now. So it had just come off a higher move high. It made a higher move low yesterday, and it's strong today. So this position, at least in the short run, for the 1 month still left to go, you have a chance with this position. So now let's go on to the next one. We have the bear put spread. Now this is the opposite of the last spread that we looked at. The bear call, or the bull call spread, is a bullish strategy. Once again, trying to maximize a little bit of potential upside in the marketplace. The bear put spread is the opposite. In this case, the trader buys a put at a select strike price. The trader then sells a put at a lower strike price of the same asset and expiration. Remember, all the trades that we're talking about today, they're all of the same expiration date, and the options all are on the same asset when it comes to whatever spread we're talking about. Now, this strategy offers limited gains and limited losses, just like the previous example. Okay, so now think of it like this: a bear put spread is the same thing as going short the stock, but if you short the stock, you have to have the margin money to cover any potential unlimited losses that you could have when it comes to shorting stock. Remember, shorting stock is not like buying stock. In buying stock, you have limited losses because you can only lose what you paid, just like when you're buying options, you can only lose what you paid for. However, when you're short, which is the opposite, then you have unlimited liability. But this is a way of being synthetically short without having the liability. This is how, remember when we started the webinar, the whole purpose of this is to teach you ways of reducing your risk, controlling your risk, defining your risk, and also increasing your potential return on your investment. And this is a strategy that will help you to do that. The upside, once again, is limited, but the risk is reduced as well with the spread. So the bearish trader will use this strategy when they're looking for a short-term correction. So remember how the market, when we first put on that slide, we showed you how there was that gap, okay? And we'll show you with the chart how this trade would have been a very good short-term play for that. This is a synthetic way of going short the market without the risk. Okay, once again. And the bear put spread is also a type of vertical spread, just like the call spread. The only difference is this time the vertical, you want it to go down. At least that's the intention. So the only downside is if the stock or ETF goes higher, and then the trader only loses the premium that was paid for this spread. So now let's make it a little clearer by looking at the chart. So once again, Coca-Cola stock price was at 53.31, January 15th, 2020 expiration options for the bear put option strategy. Now, remember when we talked about that gap in the first slide when we talked about the married puts? This is a way of trading that gap. So let's say in this situation, you notice the indexes are very bullish. The stock market keeps making higher move highs and higher move lows. That's indicative of an uptrend no matter what. That's a defined bullish market. Coca-Cola right now is in a defined medium-term bull market with higher move highs, higher move lows. Well, maybe now you're on shaky grounds here a little bit. You like Coca-Cola, but you don't want to put the money into the stock. Okay, so and also you think that the upside coming into the year end is most likely there's a chance for a correction. The corrections can happen at any time. We're not talking about how and when to time one, but we're just looking at a situation where here's a play that's a low risk play to take advantage of a potential move like that. Now, this gap, remember when we first talked about the first slide, on a fundamental technical basic principle, gaps typically get filled. So let's just say you want to, instead of shorting the stock, once again, if you were to short the stock, you would get that $5,300, but you'd have to have the margin to cover that any type of swing to the upside going against you. And remember, your risk, if you were to short the stock, would be unlimited, versus in a play like this, you could put on a spread, a debit spread, where you would be buying the 52.50 strike price, and then you'd be selling the $50 strike put. Now, in this example, it says 52 here. That's actually a $50 here. It's a little error there, but it is a $50 strike price put that we're talking about here. Now, notice that 52.50 strike and then that $50 strike, that fills that gap. So let's say you are the bearish trader and you didn't want to short the market, because that only is for very experienced people with deep pockets. And I also always say I never recommend shorting stock. That's for sure. Short other derivatives, but never stock. This is what you do. You put on a bear put spread, or you buy puts or something like that if you want to do that. So anyhow, expiration date in this time period, what happens if it goes down into this area? Well, if it breaks down into this area, this spread would be a way of taking advantage of that bearish move. Now, once again, let's see what happened with this market. So when this trade, when we made this chart, this is where this arrow, this is where it was. It took a dip down all the way to 51.05. Okay, so that means your bear put spread at that point was in the money for sure, because you were below the 52, the original put that you had purchased. Remember that you are purchasing the closer put to the market and you are selling the lower put. In this case, the 52.50 strike would have been $1.42, which is $142. That's what you would be paying for that option, and then you would simultaneously be selling the $50 strike price for 64 cents, which is $64. So you basically, it's going to cost you around $70 to purchase this spread. Now, that is to go short synthetically 100 shares of stock with a limited potential of return. However, if you look at the return, look at this. You have 52.50 to 52 even. This is your range that you would be capitalizing on. The market got down to 51. So that means that the 52.50 put at one point at that low, that was $1.50 in the money, and it was only $1 out of the money for the other put that you had, and that's the one that you sold. So obviously they both would go up in value at that time. And if you would have taken off the spread at that point, because see, once it came down to 51, it pretty much filled the gap. Okay, because if you look at how this gap goes, you have the trading beforehand, you have the trading afterhand. The real gap is from this high to this low. So that comes right into this 51 area. So when the market came down there, this would be a great way to lay off that spread, or for sure if it would fall below $50. So that's one thing you have to remember is being synthetically short the market, your only potential for profit is in this range. Once it falls below the higher strike price, heads towards the lower one or falls below it. And once it falls below $50, that for sure would be a time to exit this put spread no matter what, because you would have no potential gain left in this potential chart. So once again, remember that this is a debit. And your return on, now think about this also, for your return on investment, let's say that you were short this stock. Obviously, yes, you would, if you went down to $51, that would be just over a $2 gain if you were short. Okay, so that's $200 that you would make, but you would be risking thousands and thousands of dollars to do so. And this is where the ROI of options and option spreads really becomes something that investors and traders can not only take advantage of, but where you are really coming out ahead. You have to put thousands and thousands of dollars of risk to potentially make $200. What is your ROI on that? It is next to zero. So if that doesn't give you a little light bulb going on, it should, because if you're risking $70, in which case you could double to triple your investment off of that, why wouldn't you? So that's a 100 to 200% return. Should the market dip down definitely below $51 down to $50 even, and especially if it goes below that, because the debit that you would have paid to put on the spread, when you would sell out of that spread, your return would be every bit of at least twice on that one. So that's where you have to think about options and option strategies as not just being a less complicated way of participating in the market environment. It's a much more, it is a little more refined way of being involved in the marketplace. However, it's definitely a much more financially astute way of dealing with the marketplace. Remember that whether you're a trader or an investor, it's a business just like anything else. Like we're looking at Coca-Cola. If you were just to buy the stock, you are an owner of that company. You may have absolutely nothing to do with it, like most shareholders do. However, once you are a shareholder, once you are an equity holder, you definitely retain rights of ownership. You get dividends, what have you, and it's an asset. So now, once you hold that, buying and holding is one thing. You cannot take advantage of any other opportunities with that stock except for what you are given, which would be potential appreciation with the risk of potential loss and a potential dividend, depending on whether it does or does not pay one. Now, in this scenario with the bear put spread or even any of the other strategies, you can take advantage of the movement in Coca-Cola without bearing all of the risk that you put up by just being an outright stock investor. And definitely being, just like I said, once again, like I would never, ever suggest even to the most experienced traders of shorting any stock to begin with. It's just not I think it's un-American, but that's a personal thing. But definitely on a financial basis, unless you have deep pockets and really know what you're doing, you should never short it. The fact that options exist, that's the better place to go. All traders that I've been trading for a long time would say, before you want to short the market, put on a spread, And here's another thing to look at too. Once again, the cost basis for this. If you are, let's say, right or wrong on any of these investments, if you were, say, buying the stock or even shorting the stock, you have to be right almost all the time, or else you're capital will erode at a very, very rampant pace. And think about this. Let's say that you were in a spread in a normal stock position and you lose 10% of the value. You need to have a gain of more than 10% to recoup and get back to zero. With options and option spreads, you don't need to risk remotely the amount of capital to gain the amount of money that you would had you been right on a return, and your risk is defined and limited, meaning that, for instance, like whether it's this bear put spread or a vertical call spread, if your ROI is so much higher with the options, you don't have to be as right as often, one, to realize a profit, and two, to keep yourself from eroding your capital. Whereas when you're more capital intensive for the position, the more damage it will do. So, I mean, that's a whole webinar money management lesson for another day. But that's one of the beautiful things about the bear put spread and the other spreads that we're talking about. So now let's get on to an even better one here. We have the protective collar. So this is where a trader does own the stock or ETF. Okay, remember in the very first example, it was one where you may have owned the stock for a long time, or you may have just gotten into it. And the last two other examples, they were debit spreads, which you were trading the direction. Now, this is one that's it's kind of a marriage and similar to them, but you definitely had to have already owned the stock or ETF. So in this situation, the trader buys a put at a strike price below the underlying stock or ETF price. So very similar to the married put. And then the trader sells a call above the underlying stock or ETF price. That is just like doing a cover call, but since you're doing a put at the same time, it's called a protective collar. Now, we didn't talk about cover calls, and we're not going to confuse things. So just think of it, just know that this is what you have to do. You have to sell a call above the underlying stock price. So now the options must have the same expiration date. Remember, once again, just reinforcing that these are basic fundamentals. You're like, he said this 5 times already. Well, that's because people do make the mistake when they place orders. I've seen it happen many times over the years. Professionals do it all the time. People who do it for a living do it all the time. So always make sure when you're placing these things, you have the proper dates. This is used when a trader has been long and seen substantial gains. So once again, this is where you had the position on for a while. You're happy with it. And we're using Coca-Cola once again. So this is for the long-term bull, someone who's always going to be long the stock, but wants to manage their risk with it, especially when you've had gains. Why wouldn't you do so? It's like I always tell people, if you're outright long the stock, you should always have a protective stop in the market so you can avoid big swings. If you don't, then you should have protective option spreads on, especially if you have seen substantial gains and there's a substantial positions. So once again, the strategy gives the trader downside protection of the underlying asset. The put locks in the potential sale price. So remember how we had the married put? That was locked in a floor. That's what this does. The protective collar has a floor locked into it. The trade-off is that the trader may have to sell off the asset at a higher price, thus reducing the potential upside profits. So now this is where you have to remember that, let's say you've had the asset, Coca-Cola, you love it. But for this amount of that asset, for this 100 shares or multiple blocks of 100 shares, you realize that, you know what, I made money and I'm willing to forego all of the potential upside benefits, but that's a potential. You don't know. You could still have, and remember, the stock market's on its highs. You could have a correction. We saw a violent correction this year and it came back and made new highs. Coca-Cola didn't. That's called divergence. This would make someone who's a Coca-Cola investor a little shaky right now. So if the trader has to sell the stock or ETF, though, they will be happy to do so because of the prior gains. That's the beautiful thing about this position. So let's take a look at this. Let's dissect this one. So once again, we have the $55 out of the money strike price option, and we have the $52.50 out of the money strike price option. Now, in this case, we are using a $52.50 put. Okay, remember, this is a put. A put is the right to sell a stock, okay, or ETF. This $55 OTM option is a call, which means that you have the right to buy the stock or underlying asset. Now, in this case, also, we will be selling the call, but it's not a naked call. Now, remember we said that all of these strategies will have no margin risk, and they're very basic strategies that anyone can implement no matter what level of trader you are. Reason being is there's zero margin risk. If you attach margin to a position, then it changes everything, and that would be another webinar for more advanced option traders. So, but in this case, because it is a spread, there's no margin. So even though you're selling the option, the call, it's offset. So you remember our other examples, they were either both puts or both calls. Well, now this is a put and a call, where you are buying the put, which is below the market, okay, and you are going to sell the call, which is above the market, okay. Now, what does this mean? So if the stock goes nowhere at expiration, you will have made the money on the call, which is 79 cents or $79, okay? And then you would lose the money on the put. That's if the market goes absolutely nowhere, okay? So the only risk that you have on this position would be that the stock price goes nowhere, the options expire worthless, and you lose the debit that you would have put on, which would have been basically half of the spread. So it would have been around 70 some dollars, $80, okay? So that would be your risk per spread, okay? Now, what else happens here? Should the market rally and go above 55, at that point, then you would have made money on the call. However, you could possibly get exercised. Now, this is what happens. Now people get, I don't want to get exercised on, or do I have to fear expiration? Well, you don't have to really ever fear expiration or being exercised on if you put on a position with the right outlook. Remember that for this trade, the outlook is that, first of all, you've already made money. So you're up money in the stock. So think of it like this. You're up money, the stock's at 53.30. If it goes above 55, you realize another $1.70 in appreciation on the stock. So you make money there. Anything above 55, you don't make anymore, because that's because either you're going to be exercised on and get rid of the stock, and then the option is gone. The put will expire worthless because it's below the market, or you just sell out of the spread. So that's the thing, is that it's not that the second that the market taps or goes through a strike price, do you get exercised on, okay? So usually, like I said, like we had with the other examples, if the market goes outside of your range of your spread, that's when you get out of it. Remember how whether we were in the bullish call spread or the bearish put spread, once you superseded your range, there's no more potential. So you liquidate the spread. So in this case, should the market rally, one of two things will happen. You'll either sell out of your spread, okay, in which case you would make, you would make the money on the call, okay, or excuse me, on the stock, and then your options that's where you would lose your money as far as that difference there. Okay, because you don't make the money from the debit that you had taken out already. So when you would be credited back that money, and that's the only thing that you can risk, remember, is that initial debit. Okay, but the only gain that you would have would be the premium on the stock between the 53.30 and the 55 even. So that premium, that difference gets offset by the options. And then remember that the stock, you can't make anything after $55. Now, if the market doesn't rally, okay, and like I said, if it stays where it's at, the options expire worthless. You only risk, your only premium that you lose is the premium you paid. If the stock goes below 52.50, however, that changes everything, okay? And that's where, remember, we have this gap to fill. Let's pull up this chart. So for the protective collar, when we put this thing on, remember it dipped down to $51. So what does that mean? That means that at that point, you would be down in your stock position. However, both of your options would have been working for you at this point. At this point, your call is basically worthless, and your put would have been up depending on whether you use the 52 even or the 52 half. In this example, we use the 52 half. You would be up $1.50 on that. So where you would be down in the stock, your only loss on this position would be the stock was at 53, so 52.50. So basically $1 in stock value would be all that you would have lost at that time. So when the market was down here at $51, your put would be offsetting half of the price of the, because it's the difference here between this 52.50 strike price and the stock price when you get in. That's your only potential loss. So that's how you set your floor. Remember how we said that this is a way of, like it has the married put and a covered call combined. That's the protective collar. So when the market came down to 51 to close this gap, at that point you would only lost on this position would be right here between 53 and 52.50. So once again, well, also there's the debit that you paid on the option spread. So your risk is defined, but this would also mean that you locked in your return. You already had realized gains in this stock, and you're willing to forego the upside where if the market rallies, if the stock rallies and you have to get out of the spread and get rid of the stock, you know what, you've already made money, you're going to make an extra buck. And so you make an extra $1.70 if it goes in rallies. You don't get to see any gains beyond $55. But once again, if it falls below 52.50, your only loss is less than $1 plus the debit for the option spread. And then you would have the option, you would have the ability to stay in Coca-Cola, and you would still have realized some of the gains that you had initially had earlier. And then once again, if it's now we show the chart where it's at right now, it's trading right around 53.30. So at this point, this spread would still have potential. So, because remember, it's the January 15th expiration. So if you look at where it's at now for this married put, you still have great protection, because let's say that there is a year-end sell-off, okay? And Coca-Cola comes back down to its lows and comes back to $51. In this case, owning the stock, you'd be down in the stock, but your put would still be up money, and you'd be able to sell that back and have a nice little padding to your account and realize some gains that you had foregone because you held the stock and did not sell the stock. Plus, you would also be up money on the call. Now, also remember our other spreads that we put on. Every position that we looked at today would have been in a fairly decent spot going into today. We had our married put, which is still a great protection. Remember that this market isn't a bull market, but it's interesting that while the stock indexes, the S&Ps, the Dow, the NASDAQ, and everything, they're making new highs every day. Coca-Cola has been up, but it has failed to make new highs. And right now it's going sideways. So that's called divergence. So for the stockholder in Coca-Cola, not someone who's bullish the market, you may still be bullish the overall market. This married put is great protection, whether you have the 52.50 or the $50 puts. Obviously the cost is different. So the $50 much, $52 cheaper than the 52.50. So those are good, those have good value. Now, this was done back on November 24th when we started this webinar. Today we have, it's December 16th. So you want to have this with 1 month left. If you were to put any of these trades on now, you would go for the February expiration. But we're dealing with the January. So had you done this back in January, the married put is still a great protection. The bull call spread, it has the potential to break out to the upside. It's holding this trend line, and as long as the indexes are on their highs, the broad market is lifting most stocks, even stocks like Coca-Cola. Now, the bear put spread still has strong potential. We did have a slide a couple of weeks ago. Maybe we do have a year-end sell-off, anything could happen yet, So, and then there's the protective collar, which in that case, especially going into the end of the year, this is probably one of the best positions of all, because should the market go absolutely nowhere, or if we have a correction, or even if we have a major bull run, you have a lot of potential with the protective collar. So, I mean, the only thing that where you wouldn't get anything is if we go completely sideways into January 15th. But once again, protective collar would be for the person that already had the underlying stock value. So once again, when you get a chance, check out Forex Trading Unlocked on YouTube. You can catch me in some other webinars and even past webinars for e-option. And also, if you get a chance, check out my book, High Probable Japanese Candlestick Patterns, available on Amazon.com in paperback and Kindle versions. And with e-option also, before we get to our questions, I just want to remind you to maximize your option trading potential with e-option. Remember, stock, ETF, and ETF option trading is available. Free option strategy tools like Option Play are available on their website. Also, I suggest the Option Strategy Guidebook, as well as the paper trading account to test your strategies or the strategies we talked about in this webinar. When you get a copy of this webinar, you can review it and then also try to enter them into the strategy tester. Then there's ETF and stock trades are always commission free. And remember, the option contract commissions are only 10 cents at e-option. So now let's answer some of our questions out here. First one, at any point, would it be good to buy back the call you sold? Okay, so this was a question that was asked early in the presentation when I was going through the bull call spread. You would buy back the call spread when you would offset the spread rather when you reach your potential. So because remember, you're looking for, it's a vertical spread, so you're riding it out to expiration. You're looking for it to make a move sometime between the date it was entered and expiration. So you would get out of that spread once it would have rallied above the since it was the bull call spread, if I remember right when the question was answered. Once it got above that $55 level, that would be when you would exit the spread, because there would be no longer any potential for gain in that spread. Let's see. Next question. I noticed for the spread, the trade is only going out 30 days. I understand taking advantage of the decay, a theta decay for the option being sold, but what about the options being bought? Okay, not to get too much into the theta decay, there's the various Greeks in time decay and theta, how they move. With these positions, you'd get out of these positions at the same time, because that's how they're designed. As far as the decay, it's pretty much neutral, because it's a debit spread. There's the nuances of the Greeks for that. You could get really minute, but that's more for advanced strategies. The strategies such as the four that we talked about, or especially when it comes to either the bull or call spread, you wouldn't be trading those legs. You trade them simultaneously as a spread. So plus it's also how you get the better pricing for one. So that kind of doesn't really it's a good question, but we didn't talk about the Greeks, because for these strategies, we're not making them that complicated. I mean, when you try and if you're trying to trade the numbers like that, that's a whole different way of approaching option spreads and your outlook. These were more about the underlying instrument, like Coca-Cola or whatever stock you would choose. So it's more about having a view of that market opportunity versus options pricing and the Greeks. And that's a whole more advanced webinar that we don't want to confuse people with. But once again, good question. The next one is, if the stock price 50, how can this is the $55 and 52 even, how can they be out of the money? Well, they're both out of the money because they're different options. And I think that's why the person who answered the question, that's what you're getting at. That would be the excuse me, the last one that we went over, the collar. The out of the money means it's out of the money because the one is a call above the market, not a put. Okay, if it's in the money, and it's okay, if you had the stock is trading at 53, if the $55 was a put, that would be in the money. Since it's a call, that's out of the money. The $52 option in that example, or $52.50, that is below the market, and that is a put, so that is out of the money. If it was a call, that would be in the money. Okay, so that's why they're both out of the money. So I think that maybe in that example, when I was going over it, you didn't catch the part that the stock price was for Coke was around $53. The above the out of the money strike price above the market, since it's above, that's a call. That's where you would be selling that call and you'd be buying that put that's below the market. So I think that answers that question. Then we had, let's see, Stephanie and Desiree. Here's another one. Okay, here's a couple more. The one has to do about getting out of the spreads too. What's the right time? Once again, for the married put, that would be one where once you realize a profit, and especially like the one with the gap, like you're only going to see so much. Remember that you're using these positions either as a hedge or as a protective hedge. Okay, so when you use the married put, you're either entering that stock or ETF, or you've already been long that for a while, realizing gains, and you want to protect it. So you're either getting in and you want to limit your risk, your downside risk right off the bat, or you want to protect your gains. Okay, so that's where you would have a target. Like for instance, when the stock does make a $2, $3 move, you would adjust that. Okay, that would mean you're either taking off, using it for what it did, like in that case, a protective put, you would take out your gains there to pad your current losses on your stock, and then you would reevaluate whether you would want to either stay in that option, give it more time, or roll that option because you want more time. That's a whole nother thing. But right now, when we put these on, these were for a short-term 30 to 45 day outlook. So when you're looking to trade that in a different way, like I think you're looking at with that one, that's a totally different story. But for these, everything was with an initial plan. You always stick with your plan, and then you can reevaluate it. Like for instance, when in that Coca-Cola example where the stock dipped down to $51, that would be where the married put, you would probably get out of that one. You'd be up $1.50. You have a month left till expiration. You would take that profit, and that would be something that pads your current losses of equity, either in a position you had been in, or if it was a new stock position, the current losses that you had incurred. So it pads that. Let's see. And then here's another, there was the other one from oh yeah, once again, when you get out of the spreads, you get out of it once you've realize your maximum return. So with the vertical spreads, once again, you know for sure when to get out of them. That's a no-brainer when they exceed the upside or downside projection. So for remember for the bull call spread, you're buying the closer option, you're selling the further out option for a debit. That further out call price, whatever strike price that is, in this case, it was the $55 strike price for all the examples that we used. That's why I love using just the one stock. I think we're going to do this for more webinars. It's easier to go back to. That's where you would get out. So because there's nothing left in that vertical spread above that $55 strike price. Conversely, for the put spread, there will be the same thing as well for the bear spread. If once the market got below either that $52.50 or that $50 even strike price, that would be where you would get out of the spread because there's nothing left of value left in that spread. Remember, that's where you get your return on your investment is high with these spreads, but it's also capped and limited. So you don't get to take full advantage of a runaway bull market that happens when you have a bull call spread on. You don't get to take full advantage of a market correction like we saw earlier in 2020 from the coronavirus pandemic that rocked the market and sent most stocks down 30 to 40%. You would only realize that minimal spread between whatever options those are. So, but that's what your intention is. Remember that you're not bearing all of the risk. Remember that if you were outright long the stock and never did anything this year in Coca-Cola, you would have had to have ridden a big wave down, a good 30, 40% correction, and then and you still haven't come all the way back. So, and you would have gotten your dividends, but you would have been taking heat along the whole time, and your capital your capital equity curve would have looked like a roller coaster. Well, definitely like a V, that's for sure. So, but with options, had you had on, I mean, think about this. If just like now, when we're coming into the end of the year, the market's on its highs, we're looking at a potential extended shutdown going into the new year. The market may have another crack. You know, this is a good time to have on a married put. This is a good time to have on your collar. This may be a good time to put on a put spread where you're not risking very much and you're either locking in gains or you're taking advantage of potential market swings, you know, and not even just like the bull call spread. The market's on its highs, it's overheated in going into an environment that's very shaky. The bull call spread is a great way to be long instead of owning the stock. So I think we've answered all those questions. And with that, I'm going to pass the mic over to Gina.
Great. Thank you, Teddy. That was very interesting and informative, and we appreciate all your efforts with webinars this year. And on behalf of Regal Securities and our divisions, eOption, InvestTrade, and Regal Discount Securities, we'd like to thank all of you for attending today. If you want to learn more about option strategies mentioned today, we encourage you to go to eoption.com, as it says on the screen. We have tremendous educational resources there. You'll find all of our past webinars and as well as trading videos on there that you can listen to at your leisure. And all you have to do is go to eoption.com, and on the very top you'll see resources, and then go to education and you'll see everything there. I know the question was asked, are these strategies good for any level of investor? Any investor can learn how to do these, and we encourage you to learn about options. And again, if you go to our education section, we do have an option strategy page with clickable links on it. So for example, some of the option strategies that Teddy mentioned, a married put, a bull call, or a vertical spread, a bear put spread, or a protective collar, all you have to do is go to that strategy page and click on the link, and it'll go through with you a description of the strategy, an outlook, if you use it, whether you're bullish or bearish, your profit, as well as the expiration and assignment risk. And also some of the strategies also have a short video you can watch. So that's a very good resource if you want to learn more about the strategies that Teddy talked about today. And if you want to trade options, eOption is the place to do it. As our name implies, we are the option trading specialists. We were created by George Bocaius, who's a founding member of the Chicago Board Options Exchange, and he's been trading stocks and options for over 50 years. He created his ideal trading company for options and stock trading for people who have a passion for trading. And again, to reiterate, we offer some of the lowest option rates in the country. It's just 10 cents per option contract plus $1.99 per trade. So you can trade 10 contracts for just $2.99. And the more you do, the more you save. As well as all stock and ETF trades are zero commission. So they're all commission free, and there's no hidden charges or volume requirements or anything like that. Our pricing is very straightforward. And we also offer a free tool called Options Play, and that's a tool that scans thousands of stocks each day to help you set up the right option trade to fit your needs. Normally it's $500 annually, but it's free for all of our customers. So we encourage you, if you are an eOption, InvestTrade, or Regal Discount customer, all you have to do is log into your trading account and you will see an Options Play tab. And if you aren't a customer, we encourage you to go to eoption.com and sign up, and that will be free to you, and you can start using that right away. And that's a popular tool that our investors use, whether they're a beginning option trader or they're an advanced. We find people of all levels really enjoy that. And next, I would say mark your calendar for our next webinar. That's on Wednesday, January 20th at 1 p.m. Central Time, and it's using Options Play to trade earnings. So the tool I just spoke about, we're going to have the president of eOption talk about how to use the tool, and he'll walk you through how to trade earnings this January. And again, I'd just like to reiterate, a video recording will be available later this week on our website, and it will also be emailed to you so you can watch it again at your leisure. And as it says on the screen, make sure to like us on Facebook. You'll get advance notice of any webinars, and we also give you investing tips as well as market updates. And on behalf of Regal Securities, again, eOption, InvestTrade, and Regal Discount Securities, we'd like to thank you for attending, and happy holidays and happy trading. Thank you again for your time, and have a wonderful day. Bye now.